Hank Brock is a financial consultant with Brock and Associates, and today Hank is here to tell us about an interesting concept that a lot of people don't know about, which involves our money and our estates.
Yes, we're going to talk about how to give your estate away twice and have the IRS pay for it. And this can apply to estates as little as $300,000 and all the way up to estates worth tens of millions. And so to get to that, let's take a look at some of these slides here. Okay, so let's talk about how to give your estate away twice and have the IRS pay for it. First of all, in this strategy, we're going to talk about how to increase your annual income, have an income that grows with inflation, have an income that you cannot outlive, have an income that is wholly protected from creditors, that is, to protect your assets from frivolous lawsuits. We're going to talk about how to give your entire estate to charity. We're going to talk about how to give your entire estate to your heirs. In fact, your heirs will actually get double what they would have gotten. We're going to understand how tax savings will actually pay for the strategy. That is through a wealth replacement trust funded by life insurance. And as I mentioned, this is for estates of $300,000 plus excluding your home. Now let's look at this little comparison. Here we assume assets above the estate exemption and excluding your home, and the insurance policy is paid for by tax savings plus a portion of the increased income. On the left-hand side, we have your estate as current. Value today, $2 million, minus estate taxes, which are approximately 1/2 of your estate, of $1 million, gives net to your heirs of $1 million. On the right-hand side, we see with this CRT, or a CRUT or a CRAT, as sometimes they're referred to, we had the same estate today with a value of $2 million, minus estate taxes of 0. So how much are we saving there in estate taxes? As you'll see, comparing the left to the right-hand side of the screen, you're saving $1 million in estate taxes. Thus, the amount to charity is the full $2 million of your estate, plus the wealth replacement trust, which holds the life insurance, is $2 million. Net to your heirs, $2 million. Notice that your heirs are getting $2 million as opposed to before when they were only getting $1 million. And so, just to review, you draw an income for the lifetime of both spouses, you and your surviving spouse. It's accomplished with an irrevocable trust wherein the remainder, or whatever's left over, goes to charity after the second one of you passes away. And because it's irrevocable and the remainder goes to charity, you then get an income tax deduction now, immediately, and that income tax deduction may be spread over 6 years. Those income tax savings, plus a portion of the increased income, is adequate to purchase this paid up life insurance. And I put that in quotation marks because we have to run the numbers and take a look and see how it actually works. And then that life insurance policy pays your heirs much more, if not double, what they otherwise would have received. I realize I went through that quickly, but if you'd like to ask more questions or to see it again, you're welcome to go to our website at brockfc.com.
Thanks so much to Hank for taking the time to explain those steps to us, and be sure to stop by Brock and Associates for any of your financial needs.